What else? Stocks like ONGC, Zomato, Hindalco, they're all on the weaker side. Financials are not able to provide too much support, at least not right now. HDFC Bank, Shriram Finance, these are all stocks on the lower side as well. Let's look at some of the other names. Reliance, let's see what Reliance is doing. It's down about 0.7%. ICICI Bank also down about 0.5%. L&T, slightly lower. L&T is actually very close to the flat line, so let's see. On the upside, obviously, as you would expect, only Pharma and Pharma. Dr. Reddy's 5%, Sun Pharma 4%, Cipla 4%. And a bunch of PSUs are actually having a good morning. They're outshining on a day like today. NTPC, Power Grid and BEL. All these stocks are seeing green.
Well, that's right. I think the IT pack is getting hit, and particularly mid-cap IT pack is getting hit on the back of US recessionary fears. So take a look at some of the frontline F&O counters. You have Persistent Systems, KPIT Technologies. Both of them are down. Coforge as well is down close to around 2.5%. On the flip side, just to name a few of those pharma names, should we mentioned a few. Gland Pharma and Pyramid Pharma from the broader markets, both of them, they are bucking the trend. They are some of the big outperformers this morning. A few other notable names that are moving around. Well, you have Sharda Cropchem. That stock is down close to around 7%. So there may be some kind of worry on that front. So that stock, in fact, is a little bit lower in trade. A couple of other notable losers. You have L&T Tech Services. That stock as well is lower. But as we are doing that market check, I'll tell you what, the markets have cut their losses now down to close to around 100 points. The bulls will say this is something that we like, at least for the initial minutes. And if you can put the crisscross lines at just a few minutes into trade, from around 300 stocks that were advancing, now you have 900 stocks that are advancing. Good going. Mid-cap index recovers from the low point of the day.
What are we talking about? It's a normal day.
I was just thinking, Surabhi, yesterday during closing,
yeah,
I think we were chatting on how tomorrow we could see a relief move, right? And I said, well, we're saying this with the risk of being immediately proven wrong. But can you be wrong and still be right? Look at
this is not bad at all. I mean, this could be a regular day. Absolutely in the market, for now at least.
And I think it'll be interesting to see the foreign number, the flow number, because is this retail once again sort of piling in a big way and supporting things and sort of buying this. And of course, I think for today, the foreign sort of activity will pick up as we go through the paces through the course of the day. So I think it's just still the initial kind of first reaction which is coming through. And so we'll have to give it time. Yeah.
Also, foreign managers will have they have a lot more to think about on their other positions in China, in South Korea, in these countries which have been slapped hard.
I think, just to give you a couple of technical levels, on the Nifty Bank, it's good to see the 200 DMA has got protected, and on the Nifty, the 20 DMA, at least as of now. You'll want both those two levels to get protected, and gives you some hope that we'll see an additional fight from here on. Expiry day as well, so things can get volatile in the final couple of hours of trade.
Absolutely.
Absolutely. And, lots to track as far as specific stocks, etc. are concerned. But let's just actually put maybe just a few other names, right, up there for our viewers before we bring in our next guest. Do we have our market master with us? And I think we should be able to go to them in a bit. So, it is all pharma. The biggest volume-led gainers are Oro, Dr. Reddy's, Lupin, Sun, Cipla, Zydus, Gland, Divi's, Piramal, Laurus. My God, Glenmark. It is between 3 and 9% gains, and we should actually have those up at the bottom of the screen. So this is the biggest volume-led. Mankind, you can throw in Marksons, you can throw in Newland, you can throw in Moripun, you can throw in Supriya Life Sciences, 3.5%. And I'm not looking at some aggregation of pharma stocks, but I've just sorted the biggest volume-led gainers as far as the NSE is concerned, and this is what is coming up. About 10, 12 names, but all from that one space, at least for now.
Oh, absolutely, yeah. So not too bad. Now, how is the Indian side getting ready for its response? Sources have been telling us that Indian officials are right now analyzing the impact of the differential and reciprocal tariffs. We have our colleague Abhimanyu joining in. He's been working the phone lines to see. Till now, no official response from India. We've seen that from a lot of countries. We've seen that from the EU, Australia, China, not yet from India. Abhimanyu, what's the latest?
India is analyzing the impact of differential and reciprocal tariffs. Now, these tariffs are going to kick in two phases. The first phase would be 10% of tariffs kicking in from the 5th of April. And additionally, 16% of tariffs are going to kick in from the 10th of April. What sources have indicated so far that the government is studying the impact, is analyzing the impact, and it has also indicated that differential tariffs will mean a mixed bag for India, which means gains in some sectors and also losses in some sectors due to to variation in competition with several countries. Also, sources have indicated that the clause 4 of the American order clearly says that the American president retains the power to cut tariffs with countries which are going to address the American concerns. India is already engaged in BTA negotiations with the United States, and both the countries aim to conclude the first tranche of the BTA negotiations within 2025 itself. So India, of course, remains engaged in negotiations with the US, and what had earlier been indicated that sectoral level, expert level talks would start virtually in the next few weeks, and expert level engagements will also possibly pave the way for in-person talks between both the countries. It remains to be seen what is going to be the overall impact. A detailed statement would be issued possibly in course of the day by the government, replete with analysis. So all eyes, of course, would be on what is going to be the possible impact.
All right. Thank you very much for that. Sandeep Bhatia is with us, Managing Director and Head of Institutional Equities at Macquarie. And he's now joining us. Sandeep, good to have you with us here. Pharma, I want to just start with, I mean, any thoughts, any discussions with your team, especially with pharma, your pharma analyst in particular, on, the sector is seeing a big move.
I think it's good to see that the pharma has been exempted. I think what this means is that it's not the Trump administration not immune to domestic internal U.S. political pressures and requirements, and the pharma business is definitely integrated into the entire medical healthcare system in the U.S. So we remain positive on pharma. We like Sun Pharma, and this is, I think, an indication of what should be taken as a broader message, is that the tariffs that have just been announced are opening move, and there could be negotiations. India is already in bilateral trade agreement negotiations, and we could see changes in the tariffs for India and even for some other countries.
Gentlemen, I want to take just one moment to relish the fact that we've got, on a morning like this, we've got green on the screen. Look at the mid-cap index. It's already broken out into positive territory. Thank God for our founding fathers for always wanting to make India a very strong, resilient, domestic-facing economy, integrated with the world, but very strong domestically as well. And maybe that's what's helping us on a morning like this. That's the mid-cap index. Even the Nifty, 100 points down right now. Sandeep, so with that optimism, let me ask you the question on the broader market. As this tariff storm rages out, and foreign investors have to decide what they want to do with their positions in other markets, like I was saying, China, Korea, Japan, could India be a beneficiary at all? Could they say India's maybe least impacted, relatively speaking, so let's allocate some money? Maybe it's a very simplistic question, but I'm asking you nonetheless.
I think it's a good question. I think India is, in many ways, an economic island. We have to appreciate the fact that we will be best placed to weather the storm. I don't think that India, both in terms of its economy and its geopolitical position, is at any way disadvantaged. I think we will see near-term pressures. The real challenge actually is not directly to India, but the entire political economic system and order is being overturned, as we see. The real impact, therefore, on India will be the demand destruction that will happen globally. I think people will be very simplistic to assume that this is my exports and this is my direct impact. But remember that tariffs are going up not only for India, but tariffs are going up for other countries. And a lot of other countries around the world are significantly more globally dependent on exports to the US than India is. So I think the first impact is a very short-term direct impact, but the longer-term impact is on the entire demand, global GDP growth and trade will definitely suffer. The only other positive thing that can come from a slowing global GDP growth is energy prices may fall, but all this will happen over the next 6 to 12 months as things become clear what the final tariffs are. But definitely, as far as US is concerned, tariffs are up from where they were in 23-24.
No, absolutely, Sandeep. Take your point. I mean, the growth ramifications really need to be seen and they'll play out. But again, from a very near here and now perspective in terms of markets, would you anticipate more foreign flows?
I would think that right now is a risk-off moment. So to say that foreign flows will be rushing into India because of that, no. But yes, India will be least impacted of all the emerging markets. That much I can definitely see.
So you believe India will outperform from here on?
In terms of relative outperformance means that the rest of the market can fall apart, and if we are where we are, it's also good. So yes, India is an outperforming trade in the medium term, which is a 12-month scenario as far as I see it.
All right, Sandeep, shorter conversation today. Thank you very much for joining us. It's a pleasure having you here on CNBC TV 18. Well, let's now welcome in Neelkant Mishra, who's joining us this very busy morning, Chief Economist at Axis Bank and Head of Global Research at Axis Capital. Neelkant, good morning. Great to have you with us here. I'm sure you've been poring over the details and, of course, talking to your team and getting a sort of view out there. So I just want to get that view, Neelkant. I remember speaking with you 2 days before, 2 or 3 days back, and you said it's just going to be the opening gambit and it's going to linger. We won't get clarity and it'll go back and forth, but this basically means a lot of uncertainty. What has been announced is much harsher, Neelkant, would you agree, than what anyone thought?
Yes. The fact that the impact is not $300 billion, but closer to $700 billion is of course much bigger. The market should, I think, start getting used to the fact that uncertainty will now accentuate. So not only should we expect some countries to retaliate, we may also see significant currency movements starting to show up in the next several weeks. And as the negotiation process kicks off, because remember that these are, they have deliberately started at 50% of what they think is the effective barrier. I mean, how it has been calculated, there are enough social media calculations on how simplistic it has been. But whatever be the case, they've started at 50 because I think the assumption will be that, look, we are going to raise it further if the negotiations are not doing well. If you start to retaliate, we'll raise it further. Either way, the estimate that I put out the last time we chatted, that about 1% of global GDP at the very least of investments can get postponed because of this. I think that estimate now needs to be revised further. The $700 billion odd of extra revenue that on an annualized level the US will start now to collect is about 0.6% of global GDP. So this is effectively fiscal tightening for the world. The US, of course, not all $700 billion will come from foreign producers. For example, if you take the smartphones, if production in China and Vietnam is going to be up more than 45 to 55%, or more expensive, and that from India about 25% more expensive, I mean, the US consumers will have to pay because there's not going to be any smartphone production in the US immediately. So there will be quite a bit of that $700 billion that will actually come from US consumers themselves in the form of higher inflation. And frankly, it's only through higher inflation that tariffs actually become effective on what the US government is trying to do. So, but the US government will have some tools to provide some solace, some assumption, some comfort to the US consumer through some other tax cuts. But the gist is that this is a straight first shot 0.6% of GDP, global GDP. The postponement of production would be another 1%. I think we are talking about a significant rise in uncertainty for financial markets.
Neelkant, sorry, just to get those figures in, 1% hit to 1% hit to US GDP, right? Or global GDP?
Global. So
1% hit to global GDP.
Because of postponement of investments.
Okay.
In addition to what is actually a 0.6% of global GDP tax that the US is now collecting or wanting to.
Okay. And you briefly mentioned that enough social media posts about how this number is being calculated simplistically, etc. We had an ING economist in the morning who said, well, and he used the word, not I, he said fabricated number. So they divided the deficit by imports and arrived at that 52%. Is that really so? So they're taking the size of bilateral trade, the overall bilateral trade, and it's got nothing to do with tariffs per se, the rate of tariff. Neelkant.
Yeah, so if you plot the gap between MFN, see the executive order talks about how this started around 1934 when the US government started to have bilateral agreements, and then over time it transitioned into a global agreement, and there was a most favored nation MFN rate that was being offered that is not any consistent, and so that is how the justification is made. But when you look at, and therefore India actually on this is slightly better off because India's MFN rates were much higher than the effective tariff that has been imposed. Like India, it was 17%, but the tariff, they have calculated is about 45-50%. In Vietnam, where the effective MFN rate, average rate was 9%, their effective rate is 81%. So, which is why I think there are various other factors, and I don't think it is possible to quantify the impact of non-tariff barriers very efficiently. So some of the speculation on how this may have been calculated is right, but remember that the objectives remain the same, which we had discussed the last time. Multilateralism is over. The US does not want to get hollowed out industrially, and the dollar they want to depreciate, though I don't think this is going to help. And thirdly, that they want to generate out of revenue out of imports. So all of those three objectives are what I think we should solve for.
Okay, got that. By the way, Neelkant was talking about currency. So I'm just taking a very quick look at what the currency markets are indicating, global markets. And there are big moves playing out. Look at the yen. The yen has surged, which you would expect because of the risk haven, the risk off nature of trade. The yen is now quoting at 147 to the dollar, and that's a straight move of 1.3%. That's the kind of rise the yen has seen. The euro is stronger because the euro as a bloc is coming together with very strong statements saying that, we will stand together and we will do whatever it takes to sort of mitigate the impact. The euro is at 1.09 now. That's a 0.5% appreciation for the euro. This is all this morning trades that are taking place. The yuan has weakened to about a 2-month low, but even for the yuan, the reference point that the PBOC sets every morning is stronger than what the markets had anticipated. So that's a little bit on the currency side. Neelkant, great to be listening into your views. So for someone sitting here in India and watching all this, a very simple question. Should we feel slightly relieved because we're not as badly impacted as a lot of the Asian exporters, export-facing economies? Or is there a lot of reason to worry because of the second and third order effects? What you said, 1% being shaved off global growth itself, which eventually will come back to hit us as well.
I said more than 1%. I said 1% because of investment getting delayed. That's a broad ballpark back of the envelope thing. And in addition to the 0.6% of volatility.
In addition, so it's 1.6%, yeah. Overall impact on the global economy. Yeah.
Exactly, which is at the first shot, right? And so now we have to see second order, third order effect. So this is not going to help anyone. And I think previous speakers have also mentioned, and it's a reasonable number to work with, that we are slightly less affected directly. And remember that many of the problems that we had self-inflicted on ourselves, we are starting to solve them. Like the liquidity side, I think the RBI has been very proactive and it has shown a lot of action after stating its intent. And therefore, the liquidity premium that existed, which was very significant and which was actually slowing down the economy, is now very quickly getting whittled away. So the domestic economy actually should be on a better footing for its internal demand. So India economically, I think, will be less affected. There may even be new opportunities that come up. So if Vietnam is not in a hurry to bring down its tariffs, then there is a lot of apparel, footwear. India becomes relatively cheaper. I mean, there's a 20% gap between Vietnam and India. Tariffs on Vietnam versus tariffs on India. It's an advantage that can actually start to play out in our favor. I mean, it's very unlikely that footwear and apparel will start getting manufactured in the US because of these tariffs. So there may even be opportunities that come our way. But the channel through which I think the impact will be the worst will be the financial markets. So remember that people are just about starting to cope with the fact that this uncertainty will be there for a long time. The Fed put that the markets had become addicted to over the last 3 decades that whenever there is a problem, the Fed can cut interest rates and the things will get sorted out. This time, it is a much, much more complex problem. And the equity risk premium, which is the inherent uncertainty, which prices in the inherent uncertainty of returns in what is actually a much riskier asset class than bonds, is something that was too low and will now start to rise. So we should get used to lower price to earnings multiples. This will get priced in over several quarters and years, but I think it would be, while we are less affected because of this, in fact, the gap, as I said, between MFN rates and what has been imposed is perhaps India is much better off. Second, we are less exposed to global trade on the good side than we have than many other countries. And thirdly, our own economic headwinds that we had created for ourselves are now starting to ease. So economically, I think we'll be fine. But I think the financial markets, the currency markets, I think are going to get badly affected.
All right. Hi, Neelkant. Good to hear your thoughts. And as you said the last time around as well, equity markets could be in a bit of a dizzy and could be in a bit of a flux, as you had mentioned last time around as well. Just want to clarify a couple of things. For the Indian GDP forecast, do you see any kind of hit? Are you factoring in anything? You've already mentioned longer term that could be throwing up an opportunity because the tariffs on India are not as much as some of our peers. So in select sectors, there could be opportunities. But in the near term, are you pulling back GDP estimates by any amount? And also about the RBI. You know, the Fed is unlikely now to go ahead and cut as much. At least that's the feedback we've got in the last few hours. Do you think the RBI has it in them to effect a couple of more rate cuts for the remainder of the Yes, please.
Any change that happens over a few hours can very quickly reverse over the next few hours as well. So remember that as the economy starts to slow in the US, and it is reasonable to expect that growth will slow because even though tax cuts may be introduced, there will be a lag before they start to show up, but the price shock will be immediate. So we'll see, I mean, how that plays out. In fact, it could actually happen that the US goes into a very sharp slowdown, and in which case the Fed then sees room to cut rates. So those things will change. I think that's something that we have to get used to. But when I think about the Indian economy, see the headline level, which is the easiest to do. If you exempt pharmaceuticals and some other sectors, and you focus on what is the change in duties, effective duties, and assume that in the next 6 months, by September, I think the assumption is that the bilateral trade agreement will be done, and by then India would have actually negotiated down some of these rates. The actual impact would again be only about $10 billion, and as of now it seems it's 15-20. But it is wrong to expect that all of that will be borne by India. I think it is reasonable to expect that, like we discussed about smartphones, that some of the a reasonable part of that cost will be borne by the US consumer, because there's no way that those kind of price cuts can be offered by Indian producers. So I don't think the direct impact is that big. I think the second order effect, because of the prolonged uncertainty, the fact that global GDP itself may be slowing, that there could be IT services.
Sorry, Neelkant, go on. Sorry, go on.
So the prolonged uncertainty, think about what happens to, say, IT services exports. So those are the kind of things that we should worry about. So versus yesterday, today, is my GDP growth forecast going to be lower? Absolutely. Will it be 1 percentage point lower? Will it be half a percentage point lower? Too early to say. But I would re-emphasize that I think RBI's rate decisions are going to be far more affected by how good the monsoon is, how the hailstorms are affecting yields of wheat, how monsoon shapes up, rather than what the US Fed does.
Got it.
On the currency market, there may be some more volatility. I think you were asking the previous speaker about FII flows. Clearly, in this uncertainty, people will pull back from EMs, especially given that we are in the same basket as China and Vietnam and Thailand and many other countries which are very badly affected. So on the dollar flow side, I think RBI again will have to factor in the fact that they may have to intervene again to protect the rupee.
Got that. Neelkant, I had a couple of questions. One, do you have a specific view on pharma? Because pharma today, from a market point of view, is rallying. It's been exempted for now, looks like, but they've made a special, they've put pharma in along with other sectors like semiconductors, etc., where they're saying it's it's part of a review and sector level tariffs may still come? Or you think we should go with the fact that, well, it's not going to come? It's not happening. It's exempted. Do you have a strong view?
There is no way to have a strong view when you're not controlling the decision-making process, so you don't even know how the decisions are being taken. You only understand the broad objectives. Frankly, on pharma, this is not something which is very critical for labor and job creation. And I'm not sure if the US wants to disrupt a very large part of their healthcare system. So my understanding, my assumption would be that, and given that, the manufacturing cost gap between India and the US is like 80%, so it's very unlikely that that's going to come in. It'll only increase costs, increase, insurance premiums and all that. So frankly, I don't think this will get affected. This is too small for the US to bother about, and it is too critical for affecting, the support base of the Republicans. So I think the risk is lower, but you're right. The reason they have given is that these are critical. There are things that we don't have, so we need to sort of keep them out for now.
Okay.
Whether they will pull it back when there is a negotiation happening between China and US and India and US and say that, you know what, we are now bringing this back on the table. Those are kind of things that can happen, but at this stage, I think it's reasonable to expect that they will not be back.
And
By the way,
Neelkant, Prashant, by the way, you're asking Neelkant the hardest question, almost asking him to read Trump's mind. I don't know if his advisors or even his wife can really read what he's about to do next, right? But maybe she has an ear into these things.
I just want to ask Neelkant one thing, Neelkant, and you'll have a good sense of this, right? You said India is domestic facing, and so that's a good thing. So in that sense, lesser impacted economically because of these tariffs. Do you think the government and the RBI is already starting to do it, kind of, put all their efforts towards sort of really priming the economy in that sense to be able to withstand this global hit a little more? RBI meets on the 9th of April.
Yeah, but see, RBI has already taken a lot of action.
Correct.
Remember that they had taken out about 5 lakh crores, 5 trillion rupees of liquidity because of the dollar interventions between September and January. They have now re-injected 5.5-6 lakh crores, and
it was more from the fiscal side, Neelkant. Sorry, government side.
So government fiscal deficit. In fact, the government is already going to be less of a headwind. Remember that this whole narrative that the government was supporting the economy and is no longer because capex growth is not happening as fast is absolutely wrong. The government's fiscal deficit fell by 80 basis points of GDP in FY24. It fell by another 80 basis points in FY25, and it's basis points in FY26. So the government is less of a headwind than it was. And remember that it is because the Indian government has stuck to its consolidation path that the 10-year Indian government bond is one of the safest assets in the world right now. And you're seeing yields come down. We are seeing for the right reasons, demand-supply reasons. And therefore, I think from the government perspective, I would expect that, slight more push on domestic demand factors. Remember that we also have the advantage of having a real estate cycle, which is coming off of a 10-year downturn. It's only been 2-3 years of an upturn. There's a lot of room for growth there. So some of those policies, I think they can be definitely supportive of domestic activity levels. Even as the world goes into this reset.
So finally, Neelkant, and last question, which would be a good segue into our next discussion as well. You discussed pharma. I just want your final take on 2 more important sectors from an export sense. They were important for India, apparel and textiles, of course. And then there's electronics, where so much work has gone in the last couple of years. Do either of these 2 sectors, do you think they could potentially stand to benefit? Because other countries have been slapped with tariffs, which are far higher than where we are as well.
Absolutely. I do think so. Given that on a relative basis, now if the formula is what it was, then perhaps it explains why India's tariffs are a bit lower. But either way, the fact that India was losing out on apparel and footwear because we didn't have an FTA with the US and Vietnam and Bangladesh with their relationship with the EU and US were benefiting. Now that these sort of tariff walls become less extreme for India, will become relatively will become an advantage. Similarly, on electronics, there is so much more that can happen out of India. Think about the fact that one very large smartphone company, despite being part of PLI, had actually shifted production, most of it incremental because they were losing global share, had shifted production to Vietnam, or was doing more in Vietnam than in India. Maybe now it's an opportunity for them to start doing it in India. So there are things that will happen.
But Neelkant, on electronics, I'm just going back by everything that we've heard on iPhone, right? Because Trump always takes these, poster boys of the US dream, whether it's Harley Davidson or whether it's the iPhone. And he's been saying that why can't we make these iPhones here? And we know there's a fair amount of investment that's already gone into Foxconn's factories. The Tatas are manufacturing for them. The Apple stock, by the way, was down 6% overnight on the fears that a lot of this perhaps will have to go back to the US. So are you still confident about electronics exports as a story, growing story?
Yeah. See, remember that this is the first salvo. We don't know what the bilateral trade agreements between India and the US are going to show up. The fact that the US wants to do more semiconductors is understandable. Does the US have the manpower, which can assemble smartphones at a wage rates of 12 to 14,000 rupees a month? Is something that I think cannot be changed by tariffs. So if the concern is bilateral tariffs, I think it's the US interest. So remember that they're trying to solve for their self-interest, the end of multilateralism. They're trying to solve for generating revenue out of import tariffs. But they also realize that economically it is no longer viable for them to be assembling stuff in the US or even doing, say, camera module assembly or display module assembly. So these are things that economically are just not viable in the US. And if India does the right negotiations and can bring down the tariff rates on certain items, they will get the right rates for importing in the US, exporting to the US as well. So I don't see this as an insolvable problem, or that electronics now the story is over. I think that would be a wrong interpretation.
All right, absolutely. And Neelkant, really appreciate you joining us with that perspective. Really helpful as a frame of reference to think this through. And you may want to, if you are so inclined, can listen into the next conversation. We have the management of Arvind joining us, and we'll focus on textiles as a space, not just for the company, but for the sector. It's a sector conversation which we're going to have. So we'll take that break, and we'll have Kulin Lalbhai of Arvind join us on the other side.
Stocks because they don't have the exposure to US to have a risk. Understand as a fund manager, when we think about this, the entire tariff angle, whether it happens, when it happens, at how much rate, we don't know. But there is an added risk now to owning the stocks which have exposure to the US. Is there an added reward in owning them? The answer is no. So if there is no added reward, but there is just added risk, it just doesn't make sense to keep owning them. That's the whole perspective here.
That's an interesting point. Yeah, today we could get that relief rally, but this isn't over. And you have no idea what comes on pharma as well in the coming weeks and days, perhaps.
So to say for now.
For now.
There is relief. And that's essentially the point. But, well, we'll take what we get, because otherwise fewer places to hide in that sense. Yeah. But it's just, day one, right? There'll be, I think Neelkant made a good point. Thing which we can all understand. He put it in the parlance of a street fight. But the question to him was, can this all be reversed if a new president takes on? And he answered it by saying, if you slap someone, they slap you back. Then you kick someone, they kick you back. Then you punch someone, they punch you back. And then you say, well, let's go back to how it was. It doesn't work like that. And, so it's like a starting point. And I think we'll see a lot of moves going forward over the next many weeks and months as well. So the opening rates are on your screen. 23,180 is where we are at. It's 150 points lower. It's basically just a reversal of what we saw yesterday. It's not severe by any yardstick. It's like any other open. 0.6 lower on the mid-cap index. The small-cap index is down about 1/3% or so. And the stocks are all coming up on your screen. Pretty normal kind of a session, right? 3:1 is the declines to advances. So more down than up, and that's understandable. But for now, at least at this point, it's okay. So 260 lower on the Nifty Bank as well. That's the rate which is coming up. Let's talk about stocks, Surabhi.
Yeah, absolutely. Not bad at all compared to the declines we've seen across Asia, thanks to the fact that we're a domestic-facing country. Speaking of domestic, Dabur, 5% lower. That's the one that's taking it on the chin because of the poor Q4 update. Let's talk about Nifty stocks then. IT is weak. There's no denying that, no taking away from that. And that's the sector that's getting hit the hardest this morning. Wipro, HCL Tech, TCS, Infosys. Look at all the IT stocks. The cuts are anywhere between 1% to about 2.5%. If you go in the mid-cap space, and the cuts are even bigger on stocks like Persistent, LTI, Mindtree, Memphis. So a very clear downtrade today is IT. It's across the board down. Okay, let's move on. What else? Stocks like ONGC, Zomato, Hindalco, they're all on the weaker side. Financials are not able to provide too much support, at least not right now. HDFC Bank, Shriram Finance, these are all stocks on the lower side as well. Let's look at some of the other names. Reliance, let's see what Reliance is doing. It's down about 0.7%. ICICI Bank also down about 0.5%. L&T, slightly lower. L&T is actually very close to the flat line, so let's see. On the upside, obviously, as you would expect, only Pharma and Pharma. Dr. Reddy's 5%, Sun Pharma 4%, Cipla 4%. And a bunch of PSUs are actually having a good morning. They're outshining on a day like today. NTPC, Power Grid and BEL. All these stocks are seeing green.
Well, that's right. I think the IT pack is getting hit, and particularly mid-cap IT pack is getting hit on the back of US recessionary fears. So take a look at some of the frontline F&O counters. You have Persistent Systems, KPIT Technologies. Both of them are down. Coforge as well is down close to around 2.5%. On the flip side, just to name a few of those pharma names, should we mentioned a few. Gland Pharma and Pyramid Pharma from the broader markets, both of them, they are bucking the trend. They are some of the big outperformers this morning. A few other notable names that are moving around. Well, you have Sharda Cropchem. That stock is down close to around 7%. So there may be some kind of worry on that front. So that stock, in fact, is a little bit lower in trade. A couple of other notable losers. You have L&T Tech Services. That stock as well is lower. But as we are doing that market check, I'll tell you what, the markets have cut their losses now down to close to around 100 points. The bulls will say this is something that we like, at least for the initial minutes. And if you can put the crisscross lines, it's just a few minutes into trade, from around 300 stocks that were advancing, now you have 900 stocks that are advancing. Good going. Mid-cap index recovers from the low point of the day.
What are we talking about? It's a normal day.
I was just thinking, Surabhi, yesterday during closing,
Yeah.
I think we were chatting on how tomorrow we could see a relief move, right? And I said, well, we're saying this with the risk of being immediately proven wrong. But can you be wrong and still be right? Look at the...
This is not bad at all. I mean, this could be a regular day. Absolutely in the market, for now at least.
And I think it'll be interesting to see the foreign number, the flow number, because is this retail once again sort of piling in a big way and supporting things and sort of buying this... And of course, I mean, I think for today, the foreign sort of activity will pick up as we go through the paces through the course of the day. So I think it's just still the initial kind of first reaction which is coming through. And so we'll have to give it time. Yeah.
Also, foreign managers will have they have a lot more to think about on their other positions in China, in South Korea, in these countries which have been slapped hard.
I think, just to give you a couple of technical levels, on the Nifty Bank, it's good to see the 200 DMA has got protected, and on the Nifty, the 20 DMA, at least as of now. You'll want both those two levels to get protected, and gives you some hope that we'll see an additional fight from here on. Expiry day as well, so things can get volatile in the final couple of hours of trade.
Absolutely.
Absolutely. And, lots to track as far as specific stocks, etc. are concerned. But let's just actually put maybe just a few other names, right, up there for our viewers before we bring in our next guest. Do we have our market master with us? And I think we should be able to go to them in a bit. So, yeah, I mean, it is all pharma. The biggest volume-led gainers are Oro, Dr. Reddy's, Lupin, Sun, Cipla, Zydus, Gland, Divi's, Piramal, Laurus. My God, Glenmark. It is between 3 and 9% gains, and we should actually have those up at the bottom of the screen. So this is the biggest volume-led. Mankind, you can throw in Marksons, you can throw in Newland, you can throw in Moripun, you can throw in Supriya Life Sciences, 3.5%. And I'm not looking at some aggregation of pharma stocks, but I've just sorted the biggest volume-led gainers as far as the NSE is concerned, and this is what is coming up. About 10, 12 names, but all from that one space, at least for now.
Oh, absolutely, yeah. So not too bad. Now, how is the Indian side getting ready for its response? Sources have been telling us that Indian officials are right now analyzing the impact of the differential and reciprocal tariffs. We have our colleague Abhimanyu joining in. He's been working the phone lines to see. Till now, no official response from India. We've seen that from a lot of countries. We've seen that from the EU, Australia, China. Not yet from India. Abhimanyu,
TV18. Well, let's move on and get another sort of perspective. Samir Narang is now joining us. He's head economics research group at ICICI Bank. Pranjul Bhandari is chief India economist at HSBC. Thanks very much, Samir and Pranjul, for joining us on this important day. This is, of course, as we've been discussing, much harsh. What's been imposed is much harsher than what anyone thought. Let's just contextualize this for India. Samir, if you can start first, what is your own assessment of what's the hit? It's, of course, very simplistic because there are negotiations, there will be give and take, etc. But on a static basis, what is the hit as you see it?
So, Prashant, as all of us know, we export around $85 billion worth of goods to America. Services is on top of that. And goods typically will have, lower elasticity compared to services. So you should expect on the goods front, perhaps a 10 to 15% impact directly on India's exports to the US, and that tantamounts to somewhere around, given our overall exports to the US, $8.5 billion to say something like $15 billion. So the base case impact in our sense is that should be around 0.3% of GDP. But as has been pointed out earlier by some of the panelists, that India should also benefit given the fact that tariffs on India have gone up less than what they have gone up on China, on Vietnam, and some of the other countries which are doing a lot of contract manufacturing. So ideally, we should be better off.
To that point, and we just had the management of Arvind with us, but you've got to start with the basic sort of cost of production as well, right? I mean, is there a big difference in some of these areas on cost of production, say textiles, footwear, etc.? I mean, are those countries much cheaper? So even the tariffs for them are rising more. I mean, is it a big advantage? Is it an advantage? Does it open up a window, as some are saying? Samir, quickly.
It will, Prashant, because the cost of assembling these products in India will be far cheaper because the wage component will be a very significant part in any assembly work that is being done, including services exports. So given that, if we can get our infrastructure right, and cost of shipment is, and logistics costs are in line with the Asian countries, I think it's a very big opportunity because the 10 to 15% differential makes a lot of difference in terms of margins for the final retailers.
Pranjul, good morning. Thanks for waiting. What is your sense on some of the numbers? Assuming the numbers are what they are, but what's your perspective on how things will progress from here? Some have said this is an opening gambit, very maximum, highest cap, and then you kind of work back from there. Your thoughts, Pranjul?
Well, look, I must say that the situation is very fluid. If I come back to your channel in a few months, I'm sure, we'll be talking very different sectors, making very different points because things are changing so much. But I think my thoughts from what happened last night, number one, of course, it's come as a bit of a shock because, when I was seeing a lot of analysis around me, in a way, people were assuming a 10%, tariff addition to India, and it turned out to be more like 27%. But I think the silver lining, of course, is that, some of the other countries have got it even worse, ASEAN, China. So in a way, we're not doing that badly. So some sort of luck out there. But having said that, I think there's a lot of fluidity in a few things. Number one, in terms of which sectors are winners or losers. As in today, everybody's excited about pharma, but it's possible that something gets slapped on pharma, say, 3 to 6 months down the line. Today, we are not that excited about textiles or maybe electronics, but it's possible that, with the bilateral treaty, something sort of changes for textiles and it becomes a completely new opportunity for us. So this whole list of winners and losers are going to change dramatically. And I think that's going to bring a lot of uncertainty and volatility, into the markets. In terms of growth numbers as well, I think we need to think carefully between the direct impact on growth and the indirect impact on growth. My own sense is that, very simple back of the envelope calculation, 27% increase in tariffs across sectors, excluding pharma, can shave up about 0.5 percentage points from India's GDP growth. If you assume that some sectors are there in which the US consumers will take the hit, maybe it won't be 0.5, it will be 0.3 percentage points of growth drag in the short run. But I think this is not where the story ends. I think the second half of the story is more important. how much does global growth slow? And on the back of that, via second round effects, how much does India's growth slow? And one thing I'll be watching there a lot is FDI flows around the world, because they are a very good indicator of capex. If it slows across the board, it means that global growth, global investment is really falling. And the second round impact on India's GDP growth can actually be harsher than the first round impact. So I think these are the few things we need to think carefully about. Of course, our silver lining is that A, we have inflation which has fallen substantially. Our sense is that we'll have inflation below the 4% target for several months in a row, which gives a sort of long rope to the RBI to ease, something it's already done. I think we'll also see changes in its liquidity management facility. It's taken liquidity from deficit to surplus, but what we may see next is steps on how do you make this surplus a little bit more permanent in nature, so banks get the assurance and it actually adds to growth over time. So I think there's a lot of monetary policy easing that is there, the opportunity is there. And then the second big thing that India has, which a lot of other countries don't have, is services exports. It has not gotten into protectionism yet. It's rising very rapidly, at least right now. And that gives us this immense buffer, which many other economies don't have.
I think, I almost want to say shh to all of us, because who knows, right? I mean, services exports, God forbid if he starts looking there, then we have a real problem. So, well, fingers crossed. Hopefully, we're not going to go down that road anytime soon. But Pranjal and Samir, just a quick question to take that point forward on the RBI's response to what we're seeing. Pranjal was talking about the liquidity measures anyway that the RBI has been unleashing. Durable liquidity is what it's all about. Samir, comment on this. Do you expect any added measures over and above the prevailing domestic conditions and RBI's own liquidity mandate because of what's happening now with these tariffs? If you could quantify more liquidity steps, how many rate cuts, what are you expecting this year?
Well, the current liquidity framework, was started in 2019, operationalized in 6th of February 2020. And in that, the change from the previous framework was that the fixed repo facility, which was available to the banking system, was taken off. And it was desired that system liquidity should be in a little bit of deficit for effective monetary transmission. Since then, a lot has changed. Particularly, we have 24/7 payments. And banks have a preference to retain or hold some liquidity rather than, give it in the call money market. So in the current framework, perhaps the changes that would be required, as Pranjal was suggesting, would be operationalizing perhaps a fixed repo window in which banks have an on-tap facility which can be utilized anytime, and that will give them some comfort. It will also give a signal in terms of to the banking system for deposit costs to come down, because ultimately, unless and until deposit costs come down, for the system as a whole or for the economy as a whole, cost of borrowing on a durable basis is not likely to come down to that extent. So I think those are some of the steps on the liquidity front one should expect. We do expect RBI will continue to maintain positive, durable and surplus liquidity. And on the rate
cuts, rate cuts just very quickly.
Yeah, 25 basis points in April. Overall, I think given the impact of the current, tariff, there is a possibility that the RBI would like to also, change stance and give a signal that they would expect the liquidity surplus to continue. And this is a cycle on the liquidity and rate front, which will perhaps prolong for some more time.
Pranjal, April 9 expectations and beyond. Rate cuts?
Yes, so we think RBI can cut a lot from here on. We expect 3 more rate cuts in the year. 1 has been done, so 3 more. Overall, 100 basis points rate cutting cycle. That's 1. The second is liquidity. It's been infusing a lot of liquidity, but I think over time, steps might be taken to make them more permanent in nature, as I was saying. Third is, regulatory easing. A lot of steps have been taken. For example, bank lending to NBFCs, all of that has been eased a bit. And our sense is RBI is sort of going to be a little easier on those fronts. And fourth, something which a lot of people don't really speak about, the rupee. I think it's good to see that the rupee, is looking like a more flexible currency at this point of time. I think this has a lot of benefits. And one big benefit is that if over time supply chains get rejigged and manufacturers want to put plant in India, they want to get assurance of a flexible, market-friendly exchange rate. So I think the fact that we've moved towards that direction is also positive for us. So I think on all these 4 fronts, I must say central banking, RBI will be the only game in town, in my view, for the next couple of months in order to lift growth. It's not going to be fiscal policy, because fiscal policy is tightening, and that's probably something good. We've taken it for granted because we have it. But, the countries that don't have macro stability are paying a price for it in terms of market turmoil. Thankfully, we have fiscal, which is showing market discipline and macro stability, and monetary policy, which is supporting growth and is easing. So we have this very nice combination of growth and macro stability, which is to our favor, in this whole world of global storm.
All right, storm it is, and no one wants to touch that. The fiscal stability and, of course, lower bond yields, etc., all a consequence of that. But RBI, 9th of April, of course, rate cuts expected, perhaps assurance that liquidity will remain ample. Thank you very much, Pranjul, for joining us. Samir, good to see you back on the show. And we will chat again. As Pranjul, you said, next time we speak, I think things will be, different, and how different we'll have to see. But thanks once again, both of you. We'll take a quick commercial break here. Markets are not doing bad at all. We're down just 70 points. And by the way, briefly, the Nifty Bank had come into the green. It is in the green as we speak. It's up 30 points, but it is in the green. And I think we should just look at the small and the mid-cap indices. Small cap index is down small, 0.2%. And I think the mid-cap index is also down a little bit more, 0.6% or so on the mid-cap index. Take that break. Nilesh Shah of Kotak Mahindra Asset Management Company with his views, his perspective on the other side.
Co-powered by SBI. Best है सबको पता है.
Every move can be a step towards a winning future when you have the right strategy. And for that right strategy, I trust RBL Bank's fixed deposits to build wealth with stability. With their customer-first approach, I feel valued and secure.
Introducing Instagram teen accounts, automatic protections for teens. With built-in limits for who can contact them and the content they can see, helping teens safely connect to the people and things that matter most. Plus, teens under 16 require parental approval to change safety settings. New Instagram teen accounts, automatic protections for who can contact them and the content they can see.
What goes into this, भाई?
चलो पता लगाते हैं. Visa Infinite के साथ get exclusive dining experiences at the world's finest restaurants. Enjoy life's best moments securely with Visa. The world has infinite experiences. Find yours.
Welcome back. Well, the market's not doing too badly. The Nifty is down only around 60 points. And the point we made earlier this morning was, if the Nifty needs to fight back, it has to be on the banking names. And that's precisely what's happened. The Nifty Bank is now up close to around 100 points. Remember, the pharma index is outperforming, but there's only so much the pharma index can do. You have the big names, the banking names that have moved up, and that explains the recovery. Nilesh Shah, Managing Director at Kotak Mahindra AMC, joins us on the show. Hi, Nilesh. Good morning. Good to see you win. Well, Trump's tariffs have been announced, at least for now. And it appears, though India is going to be levied at 26-27% or thereabouts, it's at least relatively lower in comparison to our peers. How do you approach the Indian markets from here on?
So one, Nigel, President Trump has proven Sant Tulsidas correct. Sant Tulsidas wrote centuries ago, Samrat ko nahi dos kosai. And President Trump is proving that for weaker nations, WTO is there. For stronger nations, WTO doesn't matter. In fact, he has historically coined new definition of import duty, which is your trade surplus with US divided by your exports to US. That is called import duty. I'm sure we are going to see one Ivy League case study on this new definition. There's one interesting WhatsApp forward which I have received. I haven't checked the authenticity, but it has come from a reasonable source. The US has imposed mass tariffs twice in its history. One was in 1828 and second one was in 1930, roughly about 100 years apart. And both of that resulted into recession or Great Depression. Coincidentally, third tariff mass hike is also coming after 100 years. And as that WhatsApp forward suggested, you need all the people to be dead who remembered the impact of tariff on the economy before you can play that game again. Clearly, this is one game which is lose-lose for not only US, but also for other countries. There will be higher inflation in US if tariffs come into play. There could be impact on growth as supply chain gets disrupted. And this could result into US stock market correcting as the Dow futures and Nasdaq futures are indicating post-announcement of tariff. Half of American household wealth is in US equity, and 2/3 of American economy is driven by consumption. Higher inflation, lower growth, wealth effect evaporating. Could this result into stagflation in US? Well, it won't be called stagflation. It will be called hard landing because US is a developed nation. Effectively, it's a lose-lose situation for the world as the theory of comparative advantages gives way for Make America Great Again. As India... Yeah, go ahead.
No, Nilesh, I was just saying that we were so glad you were joining us because you have a knack for putting things most beautifully in the best philosophical manner. And I think on mornings like these, philosophy ultimately comes to help as well. Because, you know, first it was the financial crisis, COVID, and now this all man-made. On November 5, markets were ripping higher. That Trump is great for financial markets. And now where are we? So what would your advice be to investors?
It all depends upon how situation evolves. I will still say picture abhi baki hai. President Trump has not finished. He will continue to make announcements. And it is up to India as to how we leverage this. We have been imposed tariff duty, but it is much lower than most of our peers. In sectors like pharma, there is no tariff impact. In sectors like garment and footwear, soft toys, we could probably get business from our Asian peers. IT sector will get impacted as technology spending slow down if American growth slows down. And we'll have to be also careful about how China, with its massive manufacturing capacity, dumps goods all over the world, including India. I think there is always silver lining in the dark cloud. And if India can go and negotiate with US, especially, by leveraging oil import or defense import and reducing that trade deficit, and also showcasing that, look, in China, where you run more than $500-600 billion deficit, you are not actually able to operate in China as freely. Your Facebook, your Twitter, they are not operating in China, but they all have free runway in India. So if we can negotiate under clause 4 of the of the order and probably reduce the impact of tariff on us compared to our peers, it's a great opportunity. Markets will carefully watch how government and the entrepreneurs of India capture the opportunity and then take a call. At least as of today, market is not reacting in panic, which is positive.
Okay, so Nilesh, we hope that stability prevails. One quick last question. Remind us of the firepower calculation. In all the last 5-6 months of turbulence, it is domestic money that has helped us. Now, if these foreigners keep selling because of this global chaos, then to what extent can you keep buying? What is the average cash level? I remember you saying it was, I think, if I remember, over 2 lakh crores of firepower. But please do share the latest numbers with us.
So, Surabhi, roughly the cash balance has remained around that level. Whatever flows we are getting, it's getting invested in the large cap space mostly and couple of small and mid cap space where valuations have corrected meaningfully. Within FPI also, we have seen passive turning buyers in the month of March, passive ETFs. I hope it is harbinger of the buying by FPIs on the active side, and if not buying, at least reduction in intensity. Now, please remember that we have firepower, but we are not here to give easy exit to FPIs. If I know their trade side, if I know they are on the selling side, we are going to buy at a lower price, not at a higher price. So money is irrelevant. Once you show the card, the game will be played based on the cards you have on table.
That's an interesting point. And while it could be slightly chaotic in the near term, as an investor in mutual funds, I'm very happy to hear that mutual funds are not here to give easy exits to FPIs, which could be on the run. Who knows how this plays out? But thank you very much for joining in, Nilesh. Always value your perspective. Well, with that, I guess move to commodities now. We have Manisha joining in. Manisha, what a morning. Good morning to you.
Well, yes, it started really early for all of us, didn't it? And yes, we have seen a very strong knee-jerk reaction come in for many of these commodities as well. You know, just to remind you, well, of course, there is a risk-averse scenario that we are looking at in the international markets, but all of these commodities are global in nature. So country-specific tariffs does disrupt a lot of global trade there. So markets are looking at higher than expected US tariffs. The best-case scenario that the street was anticipating was 5 to 10% and worse between 15 to 30%. And we seem to be looking on the higher side here. 10% of baseline tariff is what we've seen all countries, and then the major producer and consumer of commodities have had it on the higher side. When you look at the China markets, well, we're looking at around a higher number of 34% there. China already is dealing with 20% of tariffs, and that makes it 54% of tariffs. And remember, China is the major consumer and producer of many of those industrial commodities. So we are looking at reaction coming in for many of those. For India, we're looking at 27% at this point in time, and that reaction clearly has come in for the gold prices, which has now made 22 days of all-time highs in 2025, and we've seen 3165 break on the higher side, 3200 in the front month futures as well. So very strong gains continuing in the safe haven buying in sense of gold there. Crude oil prices, well, 80% of countries in the global markets import crude and 20% of them produce that. So we are looking at crude prices also taking an impact from this. 3% of a decline is what we are dealing with right now. There are concerns of weak energy consumption going forward in the new fiscal, and that's what's bothering the crude prices. The metals also have had a similar scenario come in. Natural gas prices fell 4%. You have COMEX copper, which hit an all-time highs in the month of March, also has declined quite sharply, 4%. There are reports from UBS and Goldman Sachs saying that if these tariffs continue, then we are looking at a collapse in sense of copper markets going forward there. Well, zinc, aluminum prices have seen a 5.5% of a decline on the weekly basis as well. But this is overnight markets, and the iron ore prices in China fell by 6%. It has been a 3% of a decline coming in for other industrial commodities like rubber and cotton as well. And that shows you on how we've seen prices go on on weekly sense as well. We have seen some exemptions coming in like steel and aluminum articles, but remember, there already is a 25% tariff that we have seen on these metals. Auto parts is what has been exempted as well. And more importantly, while US has imposed 25% tariffs on all imports when it comes to steel and aluminum, so that is the reason they have been exempted at this point in time. The other commodities that you see exempted at this point in time is copper, semiconductors and lumber articles as well. And then it has been about bullion. By definition, bullion means gold and silver both. So as of now, there is an exemption for both of these. All exempt articles also may subject to future 232 event as well is what. So as Nilesh was telling us that this is it is not finished yet, and we could be looking at more negotiations and retaliatory tariffs, and some of these numbers perhaps pulled back as well. I also want to show you on what we've done in sense of commodities on a week-on-week basis until now, and everything has seen a decline. Barring gold, well, that's the only one that's trading on a firmer note at around 3% on the higher side. Silver is down by 3%, and that's exactly what the case has been for many of those metal prices also. So whether it's copper, aluminum and zinc, we're down 4 to 5.5% on the weaker side. So, well, yes, apart from safe haven buying in gold, everything else in the negative.
All right, Manisha, it's a very comprehensive look at what's happening across commodities right now. Time for a quick commercial break here. On the other side, our special segment, it's the economy. It's very much about the economy. Latha is going to be speaking with agri-economist Ashok Gulati and trade expert Ajay Srivastava as to which Indian sectors will be impacted most by tariffs.
Welcome to another episode of Hero Se Mulaqat. Through smart financial planning and long-term vision, Bringank has achieved the freedom to live life on his terms.
I started investing in mutual funds roughly 12 years back. I have enjoyed my investing journey so far, and now that we are excitingly awaiting the birth of our child, we would be doing it for him or her as well.
What advice would you say to people who are actually trapped in their regular 9-to-5 jobs and they somewhat feel financially stuck and financially trapped?
If you want to get rich, it requires 20 years of regular investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Mutual Fund Sahi Hai presents Nivesh Ka Sahi Kadam in association with News 18 Network. 2 लाख टक्के के नीचे
मेरी गोल्ड चेन अलमारी में।
अपने कीमती सामान को घर में यहाँ वहाँ छुपाना के साथ जुआ खेलने जैसा है।
दाव नहीं, गोदरेज होम लॉकर लगाइए। इसकी 10 गुना मजबूती, डिजिटल सिक्योरिटी और एंटी थेफ्ट अलार्म दे टेंशन फ्री सिक्योरिटी।
और एनआरआई? अरे उससे याद आया, एक एनआरआई अकाउंट खोलना है। गो फॉर एसबीआई एनआरआई अकाउंट। इजी है। एनआरआई रिलेशनशिप मैनेजर मिलेगा और पोर्टफोलियो इन्वेस्टमेंट सर्विसेज ब्रो। ओपन अकाउंट डिजिटली, इजी पीजी, लेमन स्क्वीजी। सबको पता है एसबीआई एनआरआई सर्विसेज इजी है, सबको पता है।
Hello and welcome to It's the Economy. We continue our analysis of how the 27% tariff imposition on Indian exports to the US will impact the economy. Just to remind you, it is zero tariffs on pharmaceuticals, on copper and on some energy products and semiconductors. We do export some energy products as well to the US. It is 25% on automobiles. That doesn't change. That's the global, and of course on steel and aluminium. And the 27% India-specific number impacts all the other exports. Joining us to discuss what's the impact on Indian economy, Indian agriculture and trade are two experts, Ashok Gulati, distinguished professor at the Indian Council for Research on International Economic Relations, ICRIER actually, and former chairman of the Agricultural Prices Commission, I guess the best agri-economist we have. Also joining us is Mr. Ajay Srivastava, the acknowledged global trade expert. He heads GTRI, the Global Trade Research Initiative. Gentlemen, thank you very much for your time. We do need sector-specific experts now. Dr. Gulati, first to you, sir. Our agri-exports, mainly, I understand from the numbers, is basmati rice and shrimps to the US. These are seriously impacted, you think, because of the 27%?
27 or 26%?
So no, it is 27. Apparently, Trump said 26, but in the annex, it is 27, and actually it was Mr. Srivastava who pointed that out.
Anyway, you know, looking at the tariffs on Indian products in isolation is not the right way to look at it. If you are looking at, let's say, rice, now rice tariff going all the way up to 27%, what are the options? Will they stop eating